In this video, I'm going to talk about 4 options bullish strategies. I'm going to tell you where and how to use every single strategy. Those strategies are buying a call option, selling a put, bull put, and a bull call. Let's start with the first one, which is buying a call option. You should only buy a call option when you think the price of the underlying asset will increase by value a lot, because you can only make money on the call option when the price increases more than your strike price plus the amount of premium you paid for. Let's take an example of this contract after 6 days Moderna 250 call. So you can see here, even though your strike price is $250, the underlying asset should increase more than 270 so you can be profitable. And that's because 250 is your strike price and an additional $2,000, which is the amount of premium you paid for. And I never recommend to buy out of the money call option, because the current price of Moderna is $260. So 270, 300, those contracts are out of the money because they are more than the current price. If we check the 280 contract, you can see you can only make money when the stock goes up more than $283. I'm going to show you the chart of Moderna so you can understand everything better. You can see the current price is around $260. The example that we gave, 280, it's just here. Let's check theta of this option. You can see this option can reach maximum of 0.8 theta when it's $280. That means the option will lose every single day $0.8, and the premium only of this option is $3.8. So every single day you're going to lose 15% of your investment. Even though you can be right on the direction, but you can still lose money. That's why I never recommend to buy out of the money call options. The second strategy is selling a put option. I'm a big fan of this, and you should only sell puts if you want to buy 100 shares of the underlying asset at the strike you're setting. If we're going to sell put option, it definitely doesn't make sense if we sell in the money put option. For example, if we're going to sell a $300 contract, why you're going to sell a put at $300 if the current market price is $260? It doesn't make any sense. Why you need to buy at $300 if you can buy it at a cheaper rate? So if you're going to sell put options, the best decision that you can make is either at the money or out of the money. Why selling out of the money put options? This is why. So we said the current price is $260. Let's check again the chart of Moderna, and let's consider I want to buy at $240. I don't want to buy at $260, which is around 10% higher. I want to buy at $240. What I can do that, if you remember, if you're going to sell a put option, we have the obligation to buy 100 shares at the strike price we specify. So this is the 240 put option. The price is $1.1. So in the next 6 days, if Moderna doesn't drop to $240 and we sold that contract, we're going to collect that $100. But if it drops to $240 and at expiry it stays below $240, we're going to collect the $100, plus we need to buy 100 shares at $240. You can always sell these put options and collect premiums until it drops below $240 and you buy 100 shares. Now let's say you don't want to buy 100 shares at $240. You think $24,000 investment into one stock, it's a lot. But you want an alternative solution that they will give the same effect. So here comes the importance of bull puts. In a bull put, you're going to sell one contract and you're going to buy another contract deeper out of the money. For example, this one at $230. As you can see, your profit potential is limited and your maximum loss is limited. You have 80% chance to collect this full $200. And to reach your maximum loss, there's only 4% chance. And that happens when Moderna goes below $230. This is going to have the same effect as selling a put option, but the only difference is that your loss is limited. And you don't have the obligation to buy 100 shares if it drops a lot. The worst case that will happen is that it's going to reach your maximum loss. There's something else that I like to do on the bull puts, is that I sell deep in the money bull puts but long dated bull puts. For example, after 1 year. I do this when I believe in the long term the stock can go up a lot, but there's some risk to it. Maybe some news can make it drop. But if nothing happens, I believe that they will go up a lot. What I can do that I can sell deep in the money bull puts and my profit potential will increase a lot. Can sell this 470 contract and I can buy back this 360 put. Here you can see our profit probability decreased. Now it's 20%. So when your profit probability decreases, usually your risk reward ratio will increase a lot. That's why your maximum loss is just 1.6k and your maximum profit potential is 9k. So in this scenario, if some stupid news came up and Moderna did drop actually a lot, I'm not going to lose the same way if I bought 100 shares of a stock. I'm just going to lose 1.6k. However, if the price of the underlying asset increased a lot after 2 years or 1 year, it reached 470 for example, your profit will be $9,000. I only use this strategy when there's some risk to it. If I believe there's no risk, if Apple dropped and I think it's a great buying opportunity and I'm sure in the long term it will go up, I use different strategies because you're going to have a better win rate and better reward. But if you're going to do short-term bull puts, the best option is to sell out of the money because you will collect theta and you have a high win rate, so you can actively do it. The last example will be a bull call. This will act more like buying a call option because the net premium will be positive. This is what I mean. If we bought this contract, which is 240 call option, you can see your maximum loss is $3,600. If you don't want to risk that much, you can sell another call option which it will reduce the amount of premium you're paying. So if you bought the 240 contract, the out of the money options, they will be cheaper. So that's why you're going to sell another contract out of the money. So we sold the 270 contract. So you're going to see a different chart now. Your profit potential is limited and your maximum loss is limited, which is much lower than $3,600. It's just $1,800. And if you want to get better at options, you should open a paper trading account and just try to buy and sell those contracts and to understand better how they work. And based on that, you're going to build your own strategy depending on your risk tolerance and your trading strategy. So thanks for watching and see you in the next video.